Market news now. Emerging market stocks rose for a third straight session, taking comfort from the absence of any new signs of cracks in the global banking system, while the South African rand firmed ahead of a likely interest rate hike later in the day. Asian equities also extended gains, with Hong Kong stocks rising for the third straight session. We had internet giant Alibaba's restructuring plan helping to lift sentiment in Hong Kong's tech-heavy index. Locally, the top 40 rose just over 1%, while the rand added 0.8% to the trade at around 18.02 against the dollar, ahead of what is expected to be the South African Reserve Bank's last 25 basis point hike for this particular tightening cycle. To talk to us about the global developments, we are joined by Lukman Otunuga from FXTM. Lukman, thank you so much for your time. I mean, let's unpack what we're seeing when it comes to global sentiment right now. How are you reading things?
Thank you for having me here today. Yeah, it's a good day for global markets. Positive sentiment due to bets that we could see the peak in interest rates and, easing concerns over the banking, turmoil that, rallied market, that chaos across markets a few weeks ago. European stocks are flashing green. US futures are pointing to a positive opener, dollars weakening as investors are rushing towards riskier assets. However, though, I feel that a touch of caution may return back to markets later today as attention falls on the Fed speeches and the key economic reports from Europe and the United States today and tomorrow.
When it comes to this, banking crisis or mini banking crisis, as it has been described, is it over, or are you expecting other signs of stress to start creeping in somewhere?
And this is the trillion-dollar question. I think it may be far too early to come to any meaningful conclusion, and there's sufficient arguments of both sides that could lead to whether we may be out of the woods or more pain to come. We have to keep in mind that Silicon Valley Bank collapsed because of poor risk management, and this contagion led to the collapse of other regional banks in the US. And Credit Suisse was also dealing with its own woes. We had scandals, change of management, and heavy losses over the few years. So on the surface, this could be a contained thing, but on the other hand, we have to keep in mind that the aggressive tightening cycles done by central banks across the world, has been the cause of this. The higher interest rates have really made borrowing expensive for domestic consumers and businesses. Ultimately, this has created cracks in the financial markets, especially the bond markets. So as rates keep staying high in the medium to longer term, this could result in more turmoil. But as I said, probably it would be a good idea to revisit this in the end of Q2.
On that note, then, is the global rate hiking cycle approaching an end? What are you seeing, or at least what are the expectations?
With inflation across the globe peaking last year, it's fair to say that the global hiking cycle could be coming to an end. We've got key economic reports, inflation data from Europe and United States tomorrow, which could give us more flavor on this. But early in the week, we had inflation from Australia, which has been falling, and it's been a similar theme across the globe. And when we consider this banking crisis or the fears around it, central banks are in a tough, place where they need to choose between price stability and financial stability. And with how things are moving right now, with markets even expecting the Federal Reserve to cut interest rates as soon as September, I think it's fair to say that inflation may be a theme of the past, with rate cuts being the next new theme, if not by the end of 2023, early 2024.
What's caught my attention, at least in the past couple of weeks, that we've been talking about this mini banking crisis, has been the performance of the Japanese yen. And if you look at its performance now versus where it was a few weeks ago, where this was a currency that needed policymakers to intervene, what do you make of what we're seeing here?
Certainly, it's been a wild ride for the Japanese yen. I mean, if you look at its performance this week, yes, it's weakened against almost every single G10 currency this week due to the money risk appetite and the fact that we're seeing higher treasury yields as investors par back expectations over the Fed hiking down the road. However, though, the yen has found ample support from, global recession fears. What the Bank of Japan was doing was yield curve control. And if you look at it from the start of the year, the Japanese yen has been a really, really strong performing currency. I think moving forward, despite the weakness we're seeing, the fact that inflation is rising in Japan and speculation is growing of the Bank of Japan possibly dropping its ultra dovish stance, this could lend further support to the Japanese yen in 2023.
Over the past few days, with a lot of the other analysts who've come on to unpack the markets for us, we've been talking about the lag effects of central bank policy when they do eventually take hold. What are you going to be keeping an eye on?
I mean, ultimately, higher interest rates makes it more expensive for companies and households to borrow. You know, this holds the cash in the system and it restricts the ability to spend. So you have a situation where, you know, in the UK here, we've got higher mortgage rates, higher repayments on credit cards. Ultimately, if people are not spending, this could impact economic growth down the line. With companies as well, you know, companies are not investing or they're not borrowing to expand. We could see a rise in unemployment levels. So this horrible combination of people not spending, which would move the aggregate demand curve to the left, and you know, businesses not hiring, that could spell trouble down the line. That's another reason why we're seeing central banks starting to, you know, pause this aggressive rate hike cycle and starting to move to rate cuts down the line in an effort to stimulate economic growth.
On that note, Lukman, let's leave it there. Thank you so much for your time. That is Lukman Otsinuga from FXTM, giving us his perspective from a global side in terms of how markets are dealing with some of the change in sentiment when it comes to the mini banking crisis. However, the one thing we are looking forward to is South Africa's Reserve Bank that is expected to raise interest rates by 25 basis points for the last time in this cycle in anticipation of slower inflation and a weaker economy due to power disruptions. Now, central banks in emerging markets have conducted aggressive monetary policy tightening in the last 18 months to halt rising inflation against a backdrop of a strong US dollar compared to their local currencies, notably that of continental peer Ghana. Some other major central banks in Africa have already announced their benchmark rates this month. However, let's start off with looking at what the picture does look like for interest rates when we look at sub-Saharan Africa. We recently had the Bank of Kenya. They've been somewhat less hawkish, at least in the past, even though CPI has been sitting at 9.2%, a little bit higher from the 9.0% that we saw previously, and that was primarily driven by food and transport. They did raise their interest rates to about 9.5%. So this is an increase from what we saw of a figure that came in at 8.75% at its previous meeting. However, at the central bank press meeting, the governor of the Central Bank of Kenya did mention that they are leaving room for further tightening in anticipation of higher inflation. I just want to go back to that graph again, looking at what's happening in sub-Saharan Africa, because another major central bank is, of course, the Bank of Ghana. They've increased their interest rates to about 29.5%, and that's about 150 basis points. Going into their central bank meeting, they were expected to hold. However, their CPI sitting at around 51.2% for the month of February. In totality, when we look at the kind of interest rates we've seen from the Central Bank of Ghana, we've seen about a 14.5% increase in percentage points, rather, when we look at the kind of increases we've seen in that particular country from November 2021. Another country of interest is, of course, Nigeria. They raised their interest rates by 50 basis points to about 18% last week. Their CPI coming in at 21.9% for February. The CPI figure is at an 18-year high. And now we're going to switch back to the expectations for today when it comes to South Africa's interest rate. So this is a Reuters poll where 18 of the economists that have been polled are expecting a hike. That is that 25 basis points that we were talking about. 2 of the 20 economists that have been polled are expecting no change. And of course, no one really expecting a cut when we look at what is happening in expectations for that interest rate hike. We're expecting 7.5. This is higher from 7.25 that we saw at the last meeting. And interestingly enough, when we look at a Bloomberg survey, they're expecting the decision of that 25 basis points to be unanimous. However, we're dealing with a Reserve Bank that's basically weighing the conundrum of higher inflation, of course, a downgrade in GDP expectations, as well as global geopolitical jitters that have been fueled by what we've been seeing when it comes to tighter financial conditions. Looking at the currency performance, that's been down about 6% since the start of the year, with a lot of the investors putting a premium on the South African rand, and that's primarily driven by the logistics constraints that are weighing on economic growth. But not forgetting the electricity crisis that we are seeing. But when we look at the benchmark rate, this so far will take South Africa's benchmark rate to the highest since June 2009. And this was during the financial crisis, which was weighing quite heavily on the South African currency at the time. However, that is it from me. We're going to take a quick break, and then Nompumelelo is going to take a closer look at how South Africans are taking on more credit as they try to survive the rising cost of living.